Glad to see you today. Thanks for being on with us. I know you keep your buy rating on Disney as I comb through your latest research report. Is this the right time? Disney is going to be reopening. Are you excited about this? What needs to happen?
Good afternoon, Nicole, and thanks for having me. So first off, I think the reopening just by in and of itself brings some air of positivity to what has been a long 4 months of overhang of the park's closure. This is something that has been long awaited. Albeit, I think there's a risk factor here, right? Because we all know that the coronavirus situation has been surging in some states, including Florida. And while Disney has said that they have implemented some really extensive safety protocols, you never know how this is all going to, pan out. So from where we sit right now, we think that to the extent that they are planning for a phased reopening, as we saw in Shanghai Disneyland, they have some learning experience under their belt that will hopefully, make this reopening as safe as can be. But as I said, there is a very, very critical risk factor if things were to spiral out of control here.
So a risk factor, but it sounds like you're more optimistic about all of this, that this is a good thing to get everything rolling and closer to our new normal rather than just staying closed. So you agree with the move on Disney. You keep a buy rating and a 120 target. The employees will be clamoring because they don't want to reopen. Disney Plus has done so well. They had a recent streaming of Hamilton. So the takeaway from Disney, would you buy it now? I know you have a buy rating, but still, you like the company, or are you more worried about the potential risk?
We think that the risk actually, frankly, are something that are very, very manageable. We think the stock provides a potential for significant upside from here if they were to be able to demonstrate that this reopening can be managed effectively. There's a number of catalysts beyond the theme parks that make us to like the stock. You touched on the streaming, obviously Hamilton, and we know that Disney Plus has been benefiting from this COVID-19 lockdown. You saw ESPN, the documentary on Michael Jordan, and now they're talking to Colin Kaepernick. So if anything, I think the pandemic has given Disney some kind of fresh slate to look at its kind of programming, especially on the streaming side. And all of these things I would argue are things that they're gonna build on from here. So as we kind of look at the next 12 months, frankly, we think there's probably a lot more upside, than downside, especially also with Hollywood getting back to production, which was one thing that hobbled the content pipeline. We know that Disney has a number of marquee titles that are going to hit the theater soon as July. And we also know that the return of sports events, the Major League Soccer and also NBA, those are things that ESPN is really looking forward to that will help to jumpstart, the schedule. So all in all, we see a number of different moving parts that are heading in the right direction beyond just the reopening of the theme parks, which is what makes us like the stock.
I get it. And, I think about, as we talk about Disney and all its different revenue streams, and we talked about Disney Plus, and Netflix, for example, has had some great coronavirus numbers. In fact, I saw 42% year-over-year app downloads where they're seeing and maintain and outperform in Netflix and hiking the price target, at least one analyst, up to $5.50. So people are still liking Netflix. Do you still like Netflix?
I do, because I think this rising tide of COVID-19, if you want to call it a rising tide, it's kind of lifting a lot of the most of the streaming platforms. So I think we see Netflix riding the coattails of this tailwinds, and Disney Plus for that matter. We expect Disney Plus to report significantly better than expected numbers when they reported earnings for the subscriber additions, thanks in part to the Hamilton that you mentioned. We saw some really significant numbers, stats for the download of Hamilton. So all in all, whether it's Netflix or Disney, I think the COVID-19 has really broadened out the pie for that group at the expense of some of the more traditional competitors.
Yeah. And, and I know it's no secret to you, but Credit Suisse, for example, today was talking about the subscriber growth and just the fact that Netflix has a, quote, content advantage over HBO Max, Disney Plus, and some of the others because they've had such a big library. They haven't had to produce while some of the others are playing catch up. They haven't been able to produce any content, original content, but Netflix already had such a big library. What about a name like Amazon, the name that you've followed and you've commented on? Now we have Walmart going to take on Amazon Prime with its own version, but less than $100, right? So it's supposedly going to be similar. I don't know. Amazon, and you still like this one?
We do. I think it's going to get really interesting here, Nicole, when Walmart goes to head-to-head with Amazon on this membership subscriptions. We know that Amazon has a huge head start, not just in the U.S. but globally. And we also know that Amazon has made that Prime membership extremely compelling, whether it's the one-day delivery, Prime Video, and Whole Foods integration, and you could go down the list. So it's going to get really, really interesting to see. I would not, by any means, say that Amazon is going to lose, share to Walmart. It's quite conceivable that you could have people that subscribe to multiple both platforms, just like we see in the streaming video landscape. But all in all, I think the pie is kind of big enough. And what the pandemic has done is to kind of extend that platform and addressable market and maybe help to change consumer behavior when the COVID-19 pandemic is resolved. Both companies could actually conceivably benefit over the long term.
Yeah. I could see that consumers want to shop till they drop. They've been holed up and they want to get everything that they need. I question whether or not someone wants to pay $119 for Amazon Prime and $98 for the Walmart Plus. Those are some hefty annual costs. That being said, you've commented on some of the travel stocks, the restaurant stocks. Is there anything else that you've been talking a lot about this week when you look at these groups, Tuna?
Yeah, so Nicole, travel and tourism names, as you know, have been arguably hit the hardest in this pandemic, right? So whether it's the online travel names where we're kind of neutral, or you've got the hotels, we're also largely neutral, and then you've got the restaurants. I think the key here is that, as expensive as these names are, there are pockets of winners within each category. For example, within restaurants, you see the quick service restaurants and the pizza category actually accelerating at the expense of the fine dining and the casual chains that have been hobbled by the closure of the dining rooms. And then you've got the hotels where, for the most part, you're seeing phased reopening across the board. But now you've got surge across various states and then raising questions about how sustainable this recovery might be. At the minimum, we think the group could see several years of recovery. In the interim, most of the players are getting help from the PPP loan that was a factor in the May and June jobs report, where those groups led in the jobs recovery. But the question we have is how sustainable are those when the PPP ends? That's really the overhang on the overall leisure and travel hospitality space.
Just yes or no, would you buy any of these cruise lines? Because I know you've commented on those.
No, we don't. Cruise has been the hardest hit across the board, and there's still liquidity and solvency issues overhang, and we don't even know as we sit here when the recovery they're going to resume operations.